Here's a man who saved money for 15 years, worked hard, avoided debt, did everything financially responsible. Then, one day, he realized his money had barely grown at all. Meanwhile, people around him were building wealth through investing. So what happened? And why are millions of people in countries like the United States, Canada, the UK, Australia, and Switzerland slowly discovering that saving money alone may no longer be enough? At first, saving money feels powerful. Your bank balance grows. You feel disciplined, in control. Every month feels productive. Another $200 saved, another $500 protected. And psychologically, that feeling matters, because humans love certainty. We like seeing stable numbers. We like safety. That's why savings accounts feel comforting. Nothing moves, nothing crashes, nothing creates panic. But there was one problem. The world changed, quietly. While people were carefully saving money, the cost of almost everything started rising faster. Homes became more expensive. Healthcare exploded. Education costs surged. Insurance climbed. Groceries increased. And suddenly, what once felt financially responsible started feeling strangely ineffective. Because saving protects money, but it rarely multiplies it. And that difference changes everything. For decades, many people believed financial success came from working hard and saving consistently. But modern wealth creation started shifting towards something else: ownership, assets, investments. And that's when the gap began widening, not between rich and poor, but between savers and investors. At first, investing looked risky. The stock market moved constantly. Prices crashed. News headlines screamed panic. Recessions terrified people. Meanwhile, savings accounts looked calm, predictable, safe. But in reality, that emotional comfort came with a hidden cost. Inflation slowly eroded purchasing power, and over long periods, idle money often lost financial momentum. Meanwhile, investors were playing a completely different game. They weren't just storing money, they were buying ownership in businesses. Technology companies, healthcare giants, global brands, entire stock indexes. And historically, markets rewarded long-term ownership far more aggressively than passive saving. At first, the difference looked small, almost invisible. A few percentage points, nothing dramatic. But then compounding entered the story, and everything changed. Imagine two people starting with the exact same amount of money. One saves consistently. The other invests consistently into diversified index funds. At first, their financial lives look almost identical. But years later, the gap becomes enormous. Not because one person worked harder, not because one person was smarter, but because one allowed time to compound growth, and the other only protected cash. This is where the psychology becomes fascinating, because most people don't avoid investing due to lack of intelligence. They avoid it because uncertainty feels emotionally painful. Watching investments fluctuate creates stress. Even temporary losses can feel personal. So people retreat back towards certainty, back towards safety, back towards savings. But what nobody realizes is long-term investing was never designed to feel emotionally comfortable. It was designed to reward patience, and patience is psychologically difficult, especially during market crashes, especially during recessions, especially when fear dominates headlines. That's when many beginners panic. They sell investments, move back to cash, and lock in losses emotionally. Meanwhile, experienced investors often do the opposite, because they understand something critical. Market volatility feels dangerous, but historically, time has often reduced that volatility dramatically for diversified long-term investors. That doesn't mean markets are guaranteed to rise, and it doesn't eliminate risk, but it changes how intelligent investors think. They stop focusing on daily movement and start focusing on decades. That mindset shift changes everything. But there was another hidden problem. Most people tried investing the wrong way. They chased hype, meme stocks, cryptomania, day trading videos, get-rich-quick strategies. And suddenly, investing stopped looking like wealth building and started looking like gambling. That created even more fear, because speculation and investing are not the same thing. One depends on excitement, the other depends on discipline. And that's where many financially successful people quietly separate themselves, not through genius, not through secret information, but through consistency. Simple investing, month after month, year after year, even during crashes, even during uncertainty, even when headlines create panic. Because real wealth creation usually looks boring in real time. No drama, no overnight success, no instant millionaire story. Just systems, habits, patience, and compounding. Then something strange happens. Over time, money starts behaving differently. Instead of depending entirely on labor, assets begin generating growth independently. That's the moment many people stop thinking like workers and start thinking like owners. And psychologically, that shift is enormous, because ownership changes how people see time itself. Suddenly, every year matters, every decade matters, and short-term fear starts mattering less. This is why financially successful people often obsess less about income and more about assets, because eventually they understand something most people learn too late. Saving money creates stability, but investing creates scalability. And modern economies increasingly reward scalable ownership, not just hard work alone. That's the uncomfortable reality many people are slowly waking up to. The problem was never saving money. Saving is important. Emergency funds matter, financial discipline matters, cash reserves matter. But treating saving as the final destination instead of the starting point can quietly limit financial growth for decades. And maybe that's the biggest psychological lesson in modern finance. People naturally chase certainty, but wealth often grows through calculated uncertainty. That's the paradox. Because financially, the safest emotional decision today isn't always the safest long-term decision tomorrow. If you enjoyed this video, hit like, subscribe, and share it with someone who still believes saving money alone is enough. Because one mindset shift today can completely change someone's financial future years from now.